What's up, YouTube? Welcome back to the channel. As always, I hope you guys are having an amazing day so far today. If you're new to the channel, my name is Mike, and on this channel, we talk about personal finances such as investing in the stock market and some side hustles on how to make some extra income. So if you do enjoy making money, make sure you scroll below, click the subscribe button with the bell clicked right next to it. And if you enjoy the video, then give me one of those and like the video, as it really does help me out. So as you can tell by the title below, this video will be showing you my top 5 dividend investments for 2021. But just to remind you, I'm just some random guy on the internet. Everything in this video and all of my videos are for entertainment purposes only. I'm not a professional, so do your own due diligence. If you do enjoy or think about investing in some of these stocks and dividends that I'm invested in, do your own due diligence. I'm not a professional. If you're new to investing and don't know what dividends are, it's pretty much a thank you from companies for you investing in their stock. They can pay you out monthly, quarterly, or annually for the most part. It's pretty much a free paycheck that you'll get. Not every company offers a dividend because they feel like their money from their revenue and from earnings can be used more towards research and development, working on their manufacturing, and just growing the company as a whole instead of focusing on dividends. If you hear me use the term dividend aristocrat, that means that the company has been increasing their dividends for at least the past 25 years. And if you hear me use the term dividend king, then they've been increasing their dividends for at least the past 50 years. So as I said in the beginning of this video, I'll be showing you my top 5 dividend investments for 2021. And I do currently own each and every stock that I'm showing you. If you watch my last video on my M1 finance portfolio, I am currently invested in each and every one of these stocks. This video will not be in any particular order because I want you guys to go and do the due diligence. I'll show you my top 5, but then I want you to go and research each of these companies if you want to invest in them. And I want you to decide that this is your number 1, this is your number 2. So most of my videos, in the future, when I do a top 3, top 5, top 10, whatever, I'm not going to give you, my number 10, my number 9, my number 8, because that's mine. I want you to go and do your own research and come up with your own top numbers. First on the list is Realty Income Corporation, ticker symbol O. It's currently trading at $62.46. This stock is known as the monthly dividend paying stock because it does pay monthly. Obviously, that's why it's called the monthly dividend paying stock. It's a monthly paying dividend with a dividend yield of a solid 4.53%. They have a market cap of $23.429 billion and a PE ratio of 52.25. As you can see, if I look on the chart over here, right before the market crash and the pandemic hit around March, they were selling, they were trading around $76. I think they were up to like roughly $80 at the high of that point. Now, it doesn't mean that's going to go up that high again, but it just shows you that it has the potential to get that high again because it's currently trading at $62.45. So that's a $14 gain if it does reach those levels again. If we take a look at the website right away, you can see the monthly dividend company right at the top. It's literally in their logo because that's kind of what they're known for. If we scroll down to see the monthly dividends, strong shareholder returns. As you can see, they have a 15.3% compound average annual total return since 1994. They've paid for 670 consecutive straight months, which is very, very good. That's a great sign. 4.4 compound annual dividend growth and 93 consecutive quarterly increases, keyword increases, that they've raised their dividends. They show you how diverse their real estate portfolio is. They have over 6,500 properties under long-term net lease agreements, which is really good. They're in 49 states and Puerto Rico, along with the UK. They have 600 different clients, which is really good. It's really diverse because if they had, let's say 60 different clients, and if, they lose 5 of those clients, that's going to be a big portion of the 6,500 properties under their long-term lease. So it's really good to have a lot more clients to be. One website I really like keeping track of all my dividends. It gives me all the information I could possibly need. It's called Simply Safe Dividends. I'll leave a link in the description below. I'm not sponsored. This isn't a sponsored video. I wouldn't promote something I, don't use myself. If you sign up, you get 2 weeks for free if you use the link in the description, but they give it a 70 for their dividend safety score, which is considered safe. You can see the dividend yield right here. It's a little bit different than the one that I showed you because prices do change. The dividend yield goes up and down compared to the stock price. If you do end up using the site, you can see that it keeps track of all your shares, how much you've gained, how much you've lost, everything here. I haven't updated this in a couple weeks, so these numbers are off. I've deposited a lot more into all my current dividend stocks. If you scroll down the page, you'll get to the key metrics. This is a very important part. You can see that their payout ratio is currently 82%, which is definitely on the higher side for dividend stock. Usually you want to stay between 30 to 60%. That's kind of what I like to do, 40 to 60%. If you didn't know, REITs, which is a real estate investment trust, they do have to pay 90% back of their revenues to their shareholders in the form of dividends. They have a forward payout ratio of 80%. And if you see here, dividend streak, they've increased their dividends for the past 25 years, making them a dividend aristocrat. As I said in the beginning of the video, a dividend aristocrat, someone that increases their dividends by at least the past 25 years. And in the recession of between 2007 and 2009, they've increased their dividends, which is a very good sign. Scroll down even further, you can see that the ex-dividend, which means you have to own the stock by this date. This date will obviously change each month. You have to own these stocks before the ex-dividend date in order to collect the dividends. Because if you buy, it wouldn't make sense if it's paying March 15th. You can, have a bunch of people buy it March 14th and collect dividends. It doesn't make sense like that. So you do have to buy it before the ex-dividend date. If you look at the recent and upcoming payouts, you can see that you're getting 23 cents per share. And if you look really closely, you can see that it does increase almost every 3 months, very slightly, but over time that will add up. Next on the list is PepsiCo, ticker symbol PEP, currently trading at $132.76, 77 cents. It's currently trading hour, so it is going to be going up and down. It's got a market cap of $183.17 billion, a PE ratio of 25.93, and you can see that a current dividend yield of 3.1%. If you didn't know already, PepsiCo is not just Pepsi, the drink. It owns a bunch of different companies such as Doritos, Fritos, Lipton, Ruffles. You can see the list here. They have $23 billion brands, which means that each of these companies generate $1 billion each in estimated annual retail sales in 2020. These products are sold in over 200 plus countries and territories around the world, generating more than $70 billion in net revenue in 2020. As I said before this video, you might not have any idea that they owned all these companies. I honestly had no idea that they owned all this stuff until I started researching and investing. I don't know if it's common knowledge, but I personally did not know that they owned all of these. So if I scroll down, you can see, you might think that they're just in the beverage business, but that only 45%, not only, but it's obviously still a big chunk of it, but 45% of their revenue comes from beverages, while 55% comes with snacks. If we head over to Simply Safe Dividends, you can see that they have a solid 93, which is very safe for their dividend safety score. For their beta, which is volatility, they have an average volatility, which is good for a dividend stock. You don't want too high, too volatile of a dividend stock because you are investing it in the dividends. The more volatile a stock is, the more likely that the stock will cut their dividends. So as you can see, my shares, again, I do own this stock, but I do own a lot more than its market value. I just haven't updated in a few weeks. So if we scroll down even more, you can see the key metrics, which again is another important part. So once again, one of the key metrics that you want to look at is the payout ratio. This is sitting at 73%, which is on the higher side, but payout ratio means that they're paying 73% of their revenue back into dividends. Higher the ratio is, the higher chance it is that the company will cut their dividends. Not all the time, depends on the company, obviously. Like for Pepsi, it's got a dividend streak of 48 years. So you don't really need to worry too much about them cutting their dividends. They have increased them for the past 48 years. They increased it during the recession, but other companies, it might not be sustainable if they have a very high percentage, because that's 73% of their revenue going back into the company, or going back into dividends rather. So they might not be able to grow as much. So for a company that's as established as Pepsi, it is sustainable, but for other companies, it might be a little bit more risky. This is a dividend aristocrat. It's approaching dividend king status, which is a very good status to get, but it is at a solid 48 years increase, as I said. I scroll down even more, you can see in May of 2020, they increased their dividend by 7.1%, an average of 8% over the last 5 years, an average 10% over the last 20 years, which is very solid. Take a look at their payment schedule. This is a quarterly paying stock. They pay $4.09 per share every year. The ex-dividend right now is March 4th, so I have up until March 4th to buy as many shares as I want to get paid on March 31st. Their recent and upcoming payouts, you can see they have been increasing steadily. That's a very good sign. You don't really want to see decreases, although it does happen every once in a while where a company will cut theirs a little bit. There's a bunch of different reasons as to why companies might lower their dividends. As you can see, during the pandemic, they increased their dividends from 96 cents up to $1.02. And by the looks of it, it looks like they increase it roughly every 4 months, so we could be looking at an increase shortly. They do have a lot more information if you want to go through all this stuff. I'm not going to go through it just for time's sake, but they have really everything, all these different charts that you could possibly need, all these articles you can read on the Simply Safe Dividends. As I said, if you click the link in the description below, you can sign up for free. You get 2 free weeks, I believe, 14 free days, and then you do have to pay for it. Third up on the list is Procter & Gamble Company, ticker symbol PG, currently trading at $127, a market cap of $314.26 billion, a forward dividend and yield of 2.5%, and a PE ratio of 24.12. Just like Pepsi, Procter & Gamble owns a bunch of companies that you probably had no idea that they owned. Some of the companies that they own are Gillette, Pampers, Bounty, Tide, Bounce, Crest, Old Spice, Oral-B, and Head & Shoulders. They currently own 21 different products that generate over $1 billion in annual sales, and these products can be found in 180 different countries across the world. You can see here it says most of the company's 20 plus billion-dollar brands boast number 1 or number 2 positions in their category or segment, and P&G is number 1 in 7 of its 10 categories. P&G products touch approximately 5 billion customers daily. You know how huge of a number that is? 5 billion customers daily. You can see the list right here. You can see the rank that they are, the amount of U.S. market share they currently own. Procter & Gamble, in my opinion, will also be one of the best companies during a recession if the stock market does crash, because they sell pure necessities such as personal care, oral care, baby care, health and home care, and many more. These are necessities that every single person will need almost every single day, no matter what's going on in the world. The reason I'm not going too in depth about each of these companies, I'm going over the basics of the companies, because I want you to do the research. As I said, I'm just some random guy on the internet. I want you to go and do the research. I want to give you ideas of what companies that you can possibly add to your portfolio. But I want you to go do research. You do the due diligence and you decide on this. So I'm not going to go 20 minutes into each stock and why I own them. If you guys do want to see more in-depth reasons as to why I own these stocks, comment below and I'll make videos on specific reasons as to why I own P&G, why I own Realty Income, why I own Pepsi, and why I own all the other stocks. I'll go more in depth and target specific videos for each individual company instead of putting it all into one video. But back to Procter & Gamble. If you take a look at the dividend safety score, they got a perfect score of 99. Very safe company, 2.47 dividend yield. They have a beta score of 0.73, which is considered low. You can see my shares, once again, not updated, but I do own P&G, and along with all the other shares and all the other stocks that I talk about in this video. Scroll down, you can see that they have a payout ratio of 56%, which is towards the average. What I said, I said in the beginning of the video, between a 30 to 60, 40 to 60% is a solid percent to look for. Procter & Gamble is a dividend king, meaning they've increased it for at least 50 years. You can see that they're sitting at 63 years of a dividend streak, which is very, very good. They increased their dividends by 6% in April of 2020. Over the last 5 years, they increased by 3.5% on average. In the last 20 years, they increased by an average of 8%. It's always good to try to find a dividend growth that's over 3% per year for the last 5 years or the last 20 years, because the average inflation rate is 2%. So that means that this is growing above the current inflation rate. If you look at the annual dividends per share, you can see that it is steadily going up, which is a very good sign. You do get paid quarterly, meaning every 3 months for owning Procter & Gamble, and each year you'll get paid $3.16 per share. As you can see, the ex-dividend date has passed, and they have not announced their next dividend date yet, so this will change, in the next couple weeks or so. If you made it this far in the video, that means you're taking something from the video, which is awesome. All I ask in return is for you to smash that thumbs button. It is completely free to do. It really helps me and the YouTube algorithm get this video and all my other videos in front of more and more people, so I can try to help my best. Fourth on the list is ticker symbol T, which is AT&T, trading at $29.18. Currently, it's got a market cap of $207.93 billion and a forward dividend yield of a high 7.09%. AT&T is one of the favorites among the dividend community because of this percent. It's a solid 7%. You can see that before the pandemic hit, AT&T was trading at $37, and it's now down to $29, giving you, in my opinion, a pretty good discount. As you can see, they've added about 1.5 million postpaid phone additions, which is the highest since 2011. They have over 1 million fiber broadband net adds, and the total US HBO Max and HBO subscriptions are over 41 million. AT&T is working on growing their customer relationships through 5G wireless and fiber-based connectivity, which is huge because everyone is trying to move towards 5G, expanding breadth and reach of software-based entertainment platforms such as HBO, and commitment to customer experience and engagement, which is always very important to have a good customer experience. Since we're investing in this for the dividends, this next part's a very important part. You can see investing in strategic growth such as 5G, fiber, and HBO Max, committed to sustaining dividends at current levels, which is very important. So that means that they're not, trying to go lower than the current levels, and utilizing cash after, keyword, after dividends to reduce the debt. For their postpaid phone subscribers, you can see that they went from 63 million in the end of 2019, in quarter 4 of 2019, to 64.2 million in the fourth quarter of 2020. If you look at the yellow bar, that's postpaid phone churn, which means that's the amount of people that they lost. So they went from losing about 1% in fourth quarter of 2019 to losing 0.76% in the fourth quarter of 2020. Fiber subscribers, as you can see, is on a current uptrend as well, from 3.9 million in quarter 4 of 2019 to 5 million in quarter 4 of 2020. Yellow bar for fiber subscribers means the penetration. So that's the penetration into the entire market. So they went from a 28% market share in 2019, the fourth quarter of 2019, to a 34% in quarter 4 of 2020. HBO Max and HBO subscribers has also raised from 34.6 million subscribers in quarter 4 of 2019 to 41.5 million subscribers in quarter 4 of 2020. For premium TV losses, this might look like a bad chart, but if you really think about it and look at it correctly, this is in the thousands. So in the fourth quarter of 2019, they lost 946,000 of premium TV subscribers. And in the fourth quarter of 2020, they lost 617,000, so not as much as a year ago in 2019. If we take a look at Simply Safe dividends, you can see that they're rated 65, which is considered safe on here, and they have a beta of 0.85, which is considered average. You can see that I currently do own the stock. Once again, not updated, so I'm going to scroll right past that. Key metrics, they have a 65% payout ratio, a 66% forward payout ratio, and they are a dividend aristocrat, paying for 67 consecutive years, with increasing during the 2007 to 2009 recession. Over the last 5 years, the dividend growth is very slow, sitting at 2%, keeping just up with inflation. But over the last 20 years, it's still considered slow, but it's sitting at 4% per year. They are a quarterly paying dividend, meaning every 3 months, and an annual payout of $2.08. If you take a look at the recent and upcoming payouts, you can see that they are increasing their dividends roughly every 4 months. They're raising it by a penny on average. Last but not least on the list is Verizon, ticker symbol VZ, currently trading at $57.03 with a market cap of $235.99 billion, a PE ratio of 13.26, and a forward dividend yield of $2.51 per share, which is 4.45%. I'm sure you all know who Warren Buffett is, one of the smartest investors in the world. He has invested nearly $9 billion into Verizon. He revealed that he added 147 million shares of Verizon in quarter 4 of 2020, which is about $8.6 billion worth of the stock. I'm sure you already know that Verizon's already a huge player in the 5G space, but they're making some big moves. Verizon to expand fast 5G to NFL stadiums, music venues, and UPS delivery drones. Verizon plans to add super fast 5G mobile services to 28 NFL teams this year so that fans and the teams playing can more easily watch video replays and see multiple camera angles on plays. The company's battling rivals AT&T, which is number 4 on my list, and T-Mobile to win over consumers with faster download speeds. Carrier's expansion of 5G to 28 NFL stadiums this year is intended to provide better multimedia experiences to huge crowds. Without the upgrades, such video traffic would overwhelm existing Wi-Fi and 4G mobile networks. Verizon also plans to add 5G service inside 15 music venues. The networks will allow fans with compatible 5G phones to see video close-ups of the performers from multiple angles, much like the NFL stadium networks. Here comes a really cool part, which is drone delivery. I think this will be huge in the future, and it's awesome that Verizon's trying to get ahead of the game, right off the bat. Verizon is partnering with delivery giant UPS on using 5G to manage a planned drone delivery network. UPS will use drones from startup Skyward to deliver goods from local retail stores. Verizon's 4G and 5G network will help manage the drone traffic. Head over to Simply Safe Dividends, you can see that they're sitting at a very safe score of 87. They have a very low beta score of 0.37, meaning it's not very volatile. As you can see, I do own shares of this, but once again, not updated, so I'm going to keep scrolling. They have a payout ratio of 50%. They have a forward payout ratio of 49%, and they are a dividend aristocrat. They've increased their dividends for the past 30 years and increased it during the recession in 2007 and 2009. Although the dividend growth is on the lower side, it's at least keeping up with inflation, which is a good sign. You can see that they are a quarterly paying dividends. They pay in February, May, August, and November, $2.51 per share every single year. So there you have it. Those are my top 5 dividend stocks for 2021. But do remember that I'm not a professional. Everything in this video was for entertainment purposes only. Please go and do your own research and due diligence. If you did learn something from this video and just want to see more videos like that, please do smash that thumbs up button and click the subscribe button with the bell next to it. It really helps me and the channel out and the YouTube algorithm. As always, guys, thank you so much for watching the video. Stay safe and keep grinding. Peace.